Ladies and gentlemen, good day and welcome to Syngene International's second quarter FY24 financial results conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Suruchi Daga from Syngene International. Thank you, and over to you.
Thank you, Yashashri. Good afternoon, everyone. Thank you for joining us on this call to discuss Syngene's Q2 FY24 and H1 FY24 financial and business performance. From the management side, we have Mr. Jonathan Hunt, MD and Chief Executive Officer, Mr. Shibaji Biswas, Chief Financial Officer, and Dr. Mahesh Bhalgat, Chief Operating Officer. Post opening remarks from the management, we will open the line for Q&A, and we'll be happy to answer any questions you may have. Before we begin, I would like to caution that comments made during this conference call today may contain certain forward-looking statements and must be viewed in relation to the risks pertaining to the business. The safe harbor clause indicated in the investor presentation also applies to this conference call. The replay of this call will be available for the next few days, and the transcript will be subsequently made available. With this, I now hand over the call to Mr. Jonathan Hunt. Thank you, and over to you, sir.
Thanks, Suruchi, and good afternoon to everybody. Thank you for joining us on today's call to review our second quarter and first half performance of the financial year. I'll start my remarks with a quick overview of the key financials for the quarter before getting into some of the operational and strategic highlights. I'll then share some thoughts on the first half of the year before handing over to Shibaji to give you more of the financial details. And then, of course, we'll be happy to open up for questions as usual. Overall, the shape of the quarter was pretty much in line with expectations. Positive, I think, strong performances across the divisions, led by development and manufacturing services. Revenue from operations came in at 910 crores, that's up 18.5%, reported about 15% on constant currency basis. Operating EBITDA was up 17.4% to 254 crore. Profit after tax before exceptional items was up 20% over the corresponding quarter last year to 122 crores. So you can see some operating leverage through the P&L there. In line with our strategy and the focus on building up the development and manufacturing parts of the business, we continue to add capabilities in our development services division. We commissioned a non-GMP facility which added the capability to do early phase development projects and in what I think is an agile and cost-effective manner. In manufacturing services, we made good progress in the quarter with our biologics manufacturing partnership with Zoetis. And we also commissioned a state-of-the-art digitally enabled quality control lab that will support our growing biologics operations. Looking at the research divisions, which covers discovery services and dedicated centres, they showed together sustained growth. In discovery services, while the global demand has remained generally healthy, we did experience some softening in demand in the US-based biotech segment as it adjusts to a new funding environment. However, if you look at new capital raising in the sector over the last 2 or 3 months, it's really started to come back to pre-pandemic levels, and we expect that to normalise in due course. Overall, sector fundamentals remain strong, and we expect continued demand growth, but at a slightly reduced level in the second half of the year. Most of this will come in the next quarter, so there's our guidance for thinking about your modelling, with a strong return to growth in the fourth quarter. Again, that's teed up, as we've seen in previous years, for a very strong fourth quarter for us and quite a strong exit to the year. This short-term slowing in demand is reflected in the updated guidance that we gave for the full year on revenue. We've adjusted our annual revenue guidance to mid-teens year-on-year growth in constant currency from high teens, that was previously announced. I'll leave Sibaji to give you a bit more colour on that if needed. It's important to note that these nuances really are limited to the smaller biotech companies in the US. The major pharma companies in Europe and the UK and the large pharma companies in the US are well insulated from this funding dynamic, and we continue to see positive demand from these clients. As you know, pharmaceutical research is a long-term business, so our planning is based on market growth that we see 3, 4, 5 years down the line, and in that context, none of our plans or our expectations have changed. Hence the purchase of the 17-acre land parcel in Genome Valley in Hyderabad that we announced last quarter. That's really about giving us headroom and space, literally space to grow for the next decade or so in Hyderabad. Although our roots lie in research services, in the last few years we've also focused on building up our development and manufacturing division, the CDMO part of the business, and the long-term manufacturing contract with Zoetis provided the platform to expand our biologics capacity, and the proposed acquisition of a multimodal facility from Stelis Biopharma would be part of that strategy. Looking at the first half of the year as a whole, our financial results have been robust. Revenue growth of 22%, reported, that's about 17% on a constant currency basis, and we've achieved some important milestones that I think are a key part of accelerating and delivering our strategy. As I explained, we're expecting to see a little bit of a slower growth in research in the short term, but notwithstanding that, the order book looks in pretty good shape, and we remain cautiously positive as we head into the second half of the year. With that, let me hand over to Sibaji.
Thank you, Jonathan, and a good afternoon to everyone. I'm pleased to share with you the strong financial performance of our company for the second quarter and the first half of the year. Let me begin by discussing the second quarter performance, and I will cover the first half and updated guidance before I close my commentary. In the second quarter, we witnessed close to 18.5% growth in reported revenues from operation, which translates to around 15% at constant currency. This growth was predominantly driven by the development and manufacturing parts of our business, with commercial manufacturing of biologics being the key contributor. The Zoetis contract has now reached the run rate of around $50 million per annum as previously guided. And small molecule development services delivered steady growth driven by repeat orders from clients and strong growth in our clinical formulation business. Our research businesses continue to perform well, with the dedicated centers that we operate for BMS, Amgen, and Baxter maintaining steady growth. However, as Jonathan mentioned, Discovery Services experienced temporary softening of demand as companies adjust to the new biotech funding environment. I'm sure that you will have seen this reported by others already. The industry fundamentals for the research business remain strong, and there are already signs that the US biotech funding is getting back to more stable pre-pandemic levels, which should then bring back growth momentum in the research business over the next few quarters. The demand signals from the large and the medium biopharma companies are encouraging, so we remain optimistic, although these arrangements generally take a longer period to materialize. In the second half, we'll continue to invest in scientific capabilities and other enterprise projects, and we expect our CapEx investments to run to plan. As usual, we'll phase this over the coming quarters with the pace of execution being determined by the demand environment. Internal cash flows remain strong, and all investments are expected to be funded from internal accruals. So we'll have limited need to resort to external credit. Now moving to profitability metrics, EBITDA from operations grew at 17.4%, surpassing the constant currency revenue growth rate. Operating profit, which is EBIT, also showed strong growth at 18.4%, reflecting the impact of operating leverage on the back of improved capacity utilization in our development and manufacturing businesses. Let me now turn to some of the cost lines, and I'll explain the key changes and trends we saw in the quarter. The cost of raw materials increased by 34% year-on-year, primarily primarily reflecting the shift of business mix towards development and manufacturing services, which by nature have a higher material cost component. While the cost of raw materials was at 29% of revenues for the second quarter, we expect this to stabilize around 27 to 28% of revenues for the full year. Staff costs rose by 10.4%, tracking the increased headcounts as well as the impact of annual increment cycle, although it is worth noting that it is a lower percentage of revenue at 26.5% compared to 28.4% in the previous year. This is driven by the shift towards manufacturing, which is a less people-intensive business. Direct costs, primarily power and utility expenses, showed a decline of 4% year-on-year. This favorable trend reflects reduced utility input cost and an increase in captive green energy consumption compared to the previous year. At present, 81% of our total energy consumption is from renewable sources, an increase from the 77% last year. Other operating costs grew by 18% year-on-year, which is similar to the trend that we saw in the last quarter. As before, this increase primarily stemmed from increasing spend on the upkeep of our facilities, which are expanded with new laboratory spaces and installation of new equipment and infrastructure. Furthermore, other operating investments, especially the recruitment of commercial and scientific teams located outside India, closer to our clients, have contributed to higher costs compared to the previous year. The hedge loss for the quarter came in at rupees 18 crores compared to rupees 19 crores in the same period last year. Spot rate averaged around 82.7 rupee per US dollar during the quarter, against our hedge rate of 81.3 for the quarter. Overall, operating EBITDA margins remained at similar levels in the second quarter at 27.9% of revenue compared to 28.2% in the previous year. Depreciation charges increased by 16% year-on-year, driven primarily by asset additions across business divisions and rent from new leases entered during the period. The new lease include a non-GMP facility, which adds the capability to deliver early phase development projects in an agile and cost-effective environment. Operating EBIT margins for the quarter remained flat at 16.4% compared to the previous year. Finance costs increased from rupees 11.7 crores to 13 crores, mainly due to the increase in interest component on lease rentals. Other income increased by 40% year-on-year due to higher cash balances and improved interest yields. Turning now to tax, our effective tax rate remains stable at approximately 23%. Our profit after tax growth before exceptional items was around 20%. However, during the quarter, we had an exceptional item of rupees 5.3 crores net of tax, and this is attributable to the transaction costs relating to the acquisition of the biopharma manufacturing facility from Stelis. PAT after exceptional items grew at 14.4%. Turning now to the performance in the first half, reported revenue from operations grew at 22%, 17% at constant currency, primarily driven by development and manufacturing services. Operating EBITDA grew at 20%, while operating profit, in other words, EBIT, grew at 22%. The trend in expenses in the first half broadly mirrors that of the second quarter. The cost of raw materials increased 36% due to shift in mix towards development and manufacturing services. As mentioned earlier, the raw material costs will stabilize around 27 to 28% for the full year. Operating EBIT margins were maintained at 15%, almost in line with the first half of the previous year. Other income increased by 46%, attributed to higher cash balance and improved interest yields. On the other side of the equation, increased finance costs also reflect higher interest rates. Overall, we had a very good first half of the year with profit after tax before exceptional items growing at 23% year-on-year and profit after tax after exceptional items growing at 19% year-on-year. We have invested around $30 million in capex in the first half of the year, with around 60% of that directed towards adding new capabilities and capacities in the research business. Capex in discovery services was mainly in Hyderabad, where we opened an automated compound management facility and a DMPK biology lab for integrated small molecule studies. Hyderabad now houses close to 40% of the scientists in discovery services, making it a sizable operating footprint with further plans for capacity expansion. The rest of the CapEx was largely invested in development and manufacturing services, which includes support infrastructure such as quality control and testing laboratory for the biologics manufacturing business and additional fringe capabilities for the small molecule business. Now moving on to the revised guidance for the year. As you have seen, the first half revenue performance was in line with the guidance. The sector fundamentals remain strong. We expect continued demand growth, but at a reduced level in the second half of the year, and most of this will be reflected in the next quarter with a relatively strong recovery expected in the fourth quarter. The biologics manufacturing for Zoetis is on track and will continue to deliver strong revenues. However, please note that we started to build up revenue from the contract from the second half of the last year. So the year-on-year growth will be modest compared to what we have experienced in the first half of the year. This is built into the revised guide. In the small molecules business, several ongoing projects are scheduled to complete in the fourth quarter. So we expect lower growth in the third quarter and a strong fourth quarter, which typically is our highest in a year. Putting these factors together will result in mid-teen revenue growth for the full year at constant currency, which equates to high teens growth for the full year on a reported basis. Overall, we see the current demand growth situation from US biotech as short-term and expect it to stabilize as the biotech funding environment normalizes, signs of which are already visible. The demand situation from other client segments continue to be normal, so we remain cautiously positive in the second half of the year. Moving on to the CapEx guidance, against the revised CapEx guidance of $85 million that we indicated in the first quarter call, we now believe we will execute close to $80 million of CapEx this year, and the balance will be carried over to the next year. $30 million has been executed in the first half. Another $20 million has already been committed for execution. Of the total $80 million, more than 50% will be invested in research business, around $5 million towards upgrading the multimodal facility being acquired from Stellus, and the remaining CapEx will go for small molecule development and manufacturing service businesses and other enterprise initiatives. The acquisition of the Stellus facility is in progress, and both parties are working towards fulfilling all closing conditions. We will update you on this once we close the deal. To summarize, we had a productive half year, making progress in implementing strategic initiatives while delivering operating efficiencies. We believe we are well positioned to navigate through the temporary US biotech funding challenges, and will continue to invest in building capabilities and capacity for the growth in the future. With this, I conclude my remarks and will now take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Tarang Agrawal from Old Bridge Asset Management. Please go ahead.
Hi, good afternoon. 3 questions from my side. One, because of the IRA, right? There is an implication that perhaps it would result in the transitioning of investments from out of small molecule developments towards large molecule developments because of the stipulations laid out in the IRA. Are you seeing any signs of that happening in your interaction with the customers? So that's one. Second, in terms of your large molecule outsourcing business, are there any developments that you're seeing other than the Zoetis contract? And third, given that we've already received the approval for the Mangalore API facility, if you could comment on the ramp up of that business, say in FY25 and 26. And last fourth, a small bookkeeping one. You said $80 million of capex guidance for FY24. I would believe this is organic capex. Stellus acquisition will be over and above. If you could clarify on that. Thanks.
Yeah, the last one's a yes. Your supposition's correct on the last one. I'll talk around some of the others. The IRA, that's the Inflation Reduction Act. That's quite an interesting question. The really easy answer to your question is no, we've seen no impact whatsoever. But I'm not sure that's particularly informative. I would expect this to play out over the next 5, 10, 20 years to go to the other end of it. If it has implications for the research strategies of major biopharma companies, the decisions they make today would be about where they invest their front edge of their science. That's 3-4 years in discovery, 4-5 years in development before you even get a product. So you're effectively asking questions that are predicated if there was a decision that you would make differently today at the very front end of the R&D process. When would we see that play out? And it's a 10-year discovery development cycle. So no, there's nothing immediate happened in the last 2-3 quarters since the legislation became visible. The other bit is just around scientific technological risk. The challenge of finding a molecule and a target that works, that produces a drug, I think dwarfs the selection of is it a small molecule or a large molecule. If you look at the success rates that we all understand in drug discovery, the choice is not always there between, well, let's have a large molecule version of that same thing. So I think it's almost a false narrative to think that will be the choice between them. That said, what it will do is it will make people think around speed to market, how many things that traditionally that they will have done in the discovery development phase sequentially, and will they want to do them in parallel. So it might increase the amount of investment at any given decision stage for our clients. And then I'm going to pull it back into a net implication for us. We offer world-class science to FDA, EMEA, global standards. We do it with speed that's equivalent to our clients and in sometimes quicker. And we do that with an operating cost arbitrage that lowers the expense. So if they were going to try and do more things in parallel and they wanted to do it quickly, I can see it being advantageous, that scientific footprint, continuing the trend we already see of moving to places like India and companies like Syngene. But on the immediate premise of your question, have I seen anything in the last 12 weeks? No, I think it's way too early. It'll play out over years. Let me just pause there and see if that answer helped.
Yes, it did. Thank you.
On the other two, well, good. Having been helpful on the first question, I'm going to duck giving you specific product level guidance on either of the other two questions, which are really the same one, which is what is the outlook for our manufacturing businesses. It continues, same thing as I would have said last quarter and the quarter before that. We're out there, we're connecting with clients. We continue to see a step up actually in the number of meetings that we have with clients. We're seeing a healthy environment around, client inquiries, but I actually don't have anything to tell you because if I did, I would have put it in the press release earlier today. But our enthusiasm for being a CDMO business as well as a CRO business hasn't changed at all. I still think the capital we're deploying for shareholders is the right thing to do to create long-term value.
Okay. Jonathan, can I squeeze in one more?
Go on then.
Okay. So, I was just thinking, given the interest rate environment in the West, and while I understand that it emerges as a short-term risk in terms of the funding drying up, but purely from a medium to long-term perspective, given that capital is going to be more expensive, does it therefore not increase the requirement of businesses like ours, because creating an infrastructure, or for that matter of fact, getting the drug faster to market, will be even more important than what it was before. And in that sense, from a medium to long-term perspective, it works for us.
Yeah, I mean, if you just reverse the economics in your question, if capital is harder to get and more expensive, you may well only get a smaller amount of investment, in which case you have to work hard to make it go further. And one of the ways you can make any given dollar go further is to spend it wisely. And if you can get equivalent science, equivalent service, world-class regulatory, compliance for a lower dollar amount, which is essentially what companies like Syngene offer their clients in comparison to doing the work themselves in the West or using Western service providers, then it sharpens the value proposition we have. And that wouldn't be lost on our customers, nor would it be lost on our salespeople. Those are the sort of conversations we're having every day.
Thank you. All the best.
Thank
you very much.
We have our next question from the line of Harid Ahmed from Avendus Spark. Please go ahead.
Hi, thanks for the opportunity. Is there a bait on your margin guidance for FY24? I think earlier you guided for 30% EBITDA margin for the year. And could you also share the hedge rate for the second half of FY24?
I'm sorry. You're very muffled. Could you just restate the question, because I couldn't capture that?
So I was checking if there is an update on your margin guidance for the year. You had previously guided for 30% EBITDA margin for FY24.
Yeah, I still think it'll be around. I still think it'll be around 30%. Yeah. So there's no change in the guidance. The only thing we commented on earlier today in sort of the press release and various media interactions and in Sibaji's remarks is high teens constant currency revenue growth becoming mid-teens. By the way, I still think that's a gain share, outgrowing our market sector, outgrowing most of our competitors type performance. So it looks pretty good. On the EBITDA margin, I think we said around 30% was the phrase we used at the beginning of the year. I continue to think that everything indicates around 30% is the right guidance for the full year.
Okay.
Yeah, and on the hedge rate, our hedge is around 81 to 81.5 in that range. And I would like to remind everybody that 30% or around 30% guidance was given for the revenue translated at the hedge rate. So you can work out your arithmetic. So the guidance for margin still holds, and the hedge rate, as I said, is between 81 to 81.5.
Yeah, and actually, if you triangulate into it, I'm sure for the analysts on the call that their calculators will be running through this already. If we expect around 30% at the full year, and our average EBITDA margin rate for the first half, Sibaji, I'm looking at you, was how many?
The first half was around 28%.
Okay, so if the first half was 28% and we're going to do around 30% for the full year, one of the implications you can triangulate into is that second half EBITDA margins will be higher than first half.
Okay, understood. Sibaji, I also noticed that there's a sharp reduction in working capital by almost 20 days versus March, and especially the debtor days have come down. So trying to understand what has led to this.
Actually, we are running a very focused program on working capital improvement, and that's on receivables, inventory, payables. So all are improving. Of course, you must have also noticed a marked improvement in the receivables as well. And typically that's arithmetic because Q4 is the highest quarter for us. So, and the receivables is number of days, right, of billing. So compared to that, there is also some benefit which is coming on the receivable line. But If you take that out, overall, you will see improvement in all the lines of working capital. And it's coming out of a structured program that we are running. If you recall, during the pandemic, we built up a lot of inventory to kind of de-risk our business. And as we have settled down post-pandemic, we are optimizing inventory across the business. Although, in absolute terms, inventory will still go up as our business moves towards development and manufacturing. But in terms of proportion of the billing, we are continuously optimizing that, and you'll see that going forward as well.
Last one with your permission.
Yeah,
Stelis facility acquisition. Can you share the timelines for closing the transaction and the additional capex that you've guided for, which is around 100 crores, the timelines for spending that? And once you close the acquisition, will there be expenses hitting a P&L from the facility, or will you be capitalizing the pre-op expenses that you're incurring there?
You'll take the timeline.
Timeline, I'd expect, with the rate we're progressing, I'd expect it to close in this quarter. But it's not running to a timetable, it's running to a checklist, if that makes sense. So there are a number of things that need to be completed, closing items that need to be done, and is what will govern the closing of that deal. So it's not to a clock, it's to a checklist. But I'd expect us to get through that in the quarter. On the accounting and the financials, Subhaji.
Yeah. So as you might remember, the cost of the acquisition was around 700 crores, a little bit more than 700 crores, and we said we'll spend close to 100 crores modifying that facility. 50% of that is actually built into the capex guidance we gave, because we consider that as organic capex. So you can take anywhere between $5 to $7 million is built into the 80 million capex guidance that we're giving. Rest is for our own facilities that will be incurring.
Okay. And on the costs or on the costs that are coming through, or you're incurring it, that you'll be incurring in the facility, will it come through the P&L, or will you be capitalizing it once you close the transaction?
Are you talking about the cost of transaction, like due diligence, investment banking fees?
The operational expenses at the facility.
Okay, the operational expenses from the date of acquisition till the date of commissioning and starting operation will be capitalized.
Okay. That's very helpful. Thanks for taking my question.
Thank you.
Thank you.
Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Sudarshan Padmanabhan from JM Financial Services. Please go ahead.
Yeah, thank you for taking my question. So my question is to understand, what is really driving the near-term slowdown in the biotech spending, as you said. As I understand that there is, cost of capital that has increased very sharply, and broad outlook remains that interest rates would remain high for long. In this scenario, smaller biotech companies, I would assume, will largely be affected more as compared to, well-capitalized larger names. In this context, do we have the, versatility to shift the business from, say, smaller companies in case the slowdown, prolongs, to larger names, and also look at ramping up the manufacturing a little bit faster in case, this related issues continue?
Super. Your question's better than my answer. I think you described all of the elements of it. That's sort of what we were trying to get to in some of the comments earlier and some of the media interviews. We're a broad-based business. We've got 450 plus active clients. They cover from, I think, the very largest pharmaceutical company in the world to the smallest, newest biotech startup. I've actually met one client where it was a single person entity. They were the chief executive and receptionist all in one. So we span that whole range. It's not a case really of moving from one to another because we've always engaged with both, whether it's big pharma, big biotech, medium-sized or startups. That's one of the advantages, I think, of the breadth of capability in our strategy is we've got the ability to go with all sides of clients from discovery through to development through to manufacturing. But I think your implications are right. If I take bits out of your question, large pharma, large biotech, those companies are not dependent on the VC environment for funding. They're super well capitalized, massively cash generative, some of the biggest corporate entities in the world. So for them, it's not an issue in their decision making. They're more likely to be looking at their long-term distribution of where they do the research, where can they tap into talent.
So you were saying that, smaller companies depend more on VC, the larger companies are well capitalized, but, the versatility of the business would play in your favor.
That's super good. So that was one of my key points. The other bit I was just going to say is if you go back pre-pandemic, I think that the US biotech sub-segment was seen to be healthy, dynamic, well-funded, and a good thing for investors, biotech companies and services businesses. We then, as we went into the pandemic, had a couple of factors. One was financial macroeconomics, which was interest rates were super low, almost to the point of being negative. So capital was in search of places to be deployed. And we had a global existential threat to the whole world in a pandemic. And we saw a lot of money, possibly for me, if I look at it, certainly a generational high, maybe a lifetime high of capital going into new funding of biotech around the world, and particularly in the US. As we've come out of the pandemic, we had a very busy year in the first 12 months after the pandemic as the world tried to catch up. Some of the growth rates you saw in our business and in other businesses last year would indicate that. But simultaneously, we also saw the capital starting to move back into all of the other sectors of the economy. Think about it, during the pandemic, there were a whole industry groups that were not getting funded because they were on furlough or people were closed up. So as the capital was redeployed, it of course meant relative to an all-time peak, a much lower base. Now, there are a number of investment banks track this and report. I would point you to any number of them report on this, but the data I've seen over the year, certainly over the last 3 months, suggests that US biotech funding is now stabilizing. It's starting to settle back, and the level it's settling back at looks very similar to the levels it was pre-pandemic. So a new normal, but the normal looks very much like the pre-pandemic normal. So what I now think we have is a timing issue between raising new capital, hiring people, restarting your programs and spending it in the market with people like us. And it's going to take us, one or two quarters to work through that. But we'll have to watch it. We'll have to watch it through the quarter. But we're not the first company to comment on this. I would say we're amongst the last, actually, to have had any impact on their business. If I read CROs around the world, particularly those that are publicly listed, because they're more likely to make a quarterly comment, we're a couple of quarters into people making exactly the comments I've made today. Does that help? So it gives you a beginning, a middle, and an end, and a sense of the temporal nature of this.
Yes, definitely. So it looks like it's probably 1 to 2 quarter phenomena, and probably all your investments will pay dividends. Probably say once this issues are reallocated and you are able to reallocate.
Yeah, I mean, put it another way. When we deploy shareholders' capital into things like buying land in Hyderabad, we're taking a 20, 30-year return and value creation view and a belief that we will create value beyond our cost of capital over decades. We're not looking at it over weeks and months.
Sure. And so the next question from my side before I join the queue is, if I take the last 5 years and even post, you coming into Syngene, there has been a lot of investments not only on the capacity, on the capability side. Now, typically when you work with your clients on the research, I mean, one is you get the quantity of orders. I mean, there'll be a lot of low-hanging fruits, which an MNC company or an innovator would like to give. The second is the quality of projects where, there are certain complexity involved, probably projects with higher success rate, which unless you demonstrate your capabilities, your clients would be hesitant to give. In your experience over the last 5 years, how have you seen the quality of the projects moving up? And with the current investment, do you see the quality of the projects moving up further and also help the return ratios and the margin profile of the business?
Yes, to the first one, definitely. I mean, that's essentially our long-term strategy, is to move from efficiently doing simple things really well to where we are today, where I think we are in many ways at an equivalent level of sophistication, scientific innovation and complexity to any of our clients. We no longer sit around the sort of boardroom table or in the labs with our clients as anything other than scientific partners and equals. And that's the intention. Many of them, and if you look at some of the smaller companies, would look to Syngene and say at 8,500 people, 6,500 scientists coming on for 30 years of experience, they're actually looking to us for insight and advice based on our experience rather than to instruct us and hope that we can follow instructions. So it's changed dramatically. In parenthesis, that's not unusual in services business. And I mean, India's world leader in IT services, and there's a 30-year journey that looks very, very similar there of starting out doing simple work and following Western clients' instructions to now maybe setting the technological boundaries of what's possible. Hopefully that makes sense.
Sure. And some, more qualitative commentary on the kind of capabilities that you're building, through the CapEx?
In which aspect of the business? There's so many. If you take, for example, this Syngene model that we've got, it's a particular type of service offering where we will fully integrate all aspects of drug discovery. And effectively, that's us becoming our client, as it were, indistinguishable from them in process, approach, the ability to do not only the chemistry and the biology, but then to synthesize and integrate them and get that through to a decision-making point. There's a simple way of looking at it. There's a difference between being on the bus and driving the bus. And in something like the Syngene model, we're actually driving the projects for the client.
Yeah, and to do that, we work across therapies and platforms, so in a very versatile manner. But may I request questions to be limited to one or two because I'm sure there's a queue.
So I'll join back to you. Thanks a lot.
Thank you very much.
Thank you. We have our next question from the line of Dhiresh from White Oak. Please go ahead.
Yeah, thank you for the opportunity. I have two questions. First question is if you can share what percentage of our, let's say, last year's full year revenue we got from small biotech firms. That will be question number one, please.
Okay, that's your first question. What's your second one?
It seems in the gross margin, there seems to be some one-off this quarter. So is there a one-off this quarter? Because even assuming a certain mix of manufacturing versus discovery, the margins seem to be subdued.
Okay, so Sibaji, I'll give that one to you. The question is, are we subdued in our gross margins? While you're thinking about that, I'll do the first one on small biotech. We don't normally disclose it, but to give you a sense of it, I would guess about 15% or so of our revenue would come from, at a total firm level, would come from that US biotech segment.
Okay, thank you. 15, you said, right?
But go on, the gross margin?
On the gross margin, first let me clarify, there is no one-off. It's a function of the mix. And even within, CDMO part of our business, raw material as a percentage of revenue in small molecule and large molecules, which is biologics, are different. In a quarter where you have high biologics revenue in the overall revenue, you'll see a move towards higher raw material costs. In a quarter where you have more, small molecule CDMO, you'll have slightly lower raw material costs. So it's all in the mix. There is no one-off I can communicate that. In fact, I guess you are also taking utility and power in the cost, direct cost. That has gone down, and that has gone down quite sharply because of the multiple agreements that we have entered for green power, which also comes at a better rate for us. So it's a mixture of all those things, but no one-off as such.
Thank you. One last question. Mangalore API, have you given any utilization guidelines for FY25 or 26? Like how, at least the guide path in terms of when do you plan to fully utilize it?
No, we haven't, but it's a gift so that I can preempt the other questions. It'll be the same line of that. We roll up all of our guidance into the annual revenue and margin guidance. We don't give breakups on plant level and machine level and line level operating and utilization guidance. It's progressing in line with our broad strategic direction. I'm quite happy actually with the progress we're making in development and manufacturing. We said we would start to rebalance the shape of the business so that it was more evenly balanced between the CRO side and the development manufacturing, and that's exactly what's happening.
Thank you very much for taking my question.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Ms. Suruchi Daga from Syngene International for closing comments. Over to you.
Thank you everyone for joining today's call. If you have any further queries, please do get in touch with our team and we'll be happy to get back to you. Have a good day and thank you once again.
Thank you. On behalf of Syngene International Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.